So let me talk about the portfolio construction bit first. So I follow a concentrated portfolio approach, and the portfolio on an average comprises of 20 to 30 stocks. The reason for this broad range of 20 to 30 stocks is that in a bull market, as earnings growth expands across sectors, we naturally have a more diversified portfolio because we have more opportunities. And in a bear market, as earnings dry up, there are lesser number of opportunities available. So the portfolio becomes more concentrated during a bear market. The aim is to generate 20 to 25% CAGR for the portfolio over a minimum holding period of 3+ years at any point of time from the current price. And the focus is always on portfolio level returns because investing at the end of the day is a probabilistic activity. So some stocks will do very well, some stocks will go nowhere, some stocks may fall. So, but the focus should always be on the overall portfolio level returns. I follow a sector and market cap agnostic investing approach with a bias towards under-researched and well-run small to mid-cap companies. As far as the allocation aspect is concerned, there is no hard cap. There is no formal hard cap on the contribution to the portfolio from any one single idea or sector or market cap range, but I make sure that prudence is maintained at all times. The weight per stock ranges from 3 to 5% initially, and the exceptional opportunities sometimes get an allocation of up to 10%. The decision to sell any stock is solely based on its underlying business performance or the potential incremental IRR. The decision to sell a stock is not based on macros or overall market or overall indices short-term view. It's all bottom up. And a portion of the portfolio is kept in cash if the valuations of existing holdings and the watch list become exorbitant. Now we come to the portfolio tracking aspect. So I track industry trends of my portfolio companies like changes in competitive landscape, technology changes, government regulation changes, any supply chain disruptions. The quarterly results are evaluated for each of the portfolio companies against my own expectation, and the performance is benchmarked against that of competitors. And I carry out a detailed diligence in case any investment's performance is not as per the initial investment hypothesis, even after from a year of purchase. Finally, we come to the portfolio rebalancing aspect. So any investment is exited only if its valuations become absurdly expensive given the growth, or if there is a structural challenge to its business fundamentals. The portfolio companies are periodically ranked based on valuations, earnings performance, expected future stock returns from the current price, and the rebalance is done accordingly. And fresh or follow-on investment and an idea is done only if it can deliver an attractive IRR over a period of the next 3 years. So basically for our small case portfolios, we select companies which can double their earnings over the next 3 to 4 years. So broadly growing their earnings at between 18% and 26% CAGR. So this in a nutshell is the summary of the portfolio construction, tracking and rebalancing process.